Okay, let's continue to discuss this paper. Investor in green bonds. In the first beginning, when did you expect to get out of this presentation? So let me summarize this paper first. This paper is a Norwegian case, and they find that the paper provide insight into investor of non-government green bonds. And they found that investors in green bonds are smaller and most likely to be individual, which might be different from the regular bonds. And they find that green bonds holder have a riskier portfolio compared with others, traditional bonds. And they have higher defaults rate too. So this paper examine different dimension. They are not examining the pricing model, higher or lower year to maturity. They are examining the heterogeneity of the investor type and also the volatility of the green bonds. But they found that this portfolio of green bonds are most likely to be in oil, gasoline, not most likely to be renewable energy. So they have a worsened CO2 emission. And overall, these results are consistent with a consequentialist results rather than a warm growth investment motive. So this paper have a very specialty on their dimension of dependent variable, which is the risk measures, volatility, holding period, and default rate. And also they control for different green bonds type. So we can know a lot of heterogeneity of the investment type. So the motivation and the question of this paper have a lot, but because green bonds actually aim to finance climate-friendly project. But currently, they have a very small portion of investment portfolio. So investors in green bonds differ significantly from those in traditional bonds. They're very smaller, very individual focus, and they have a higher risk tolerance. So despite their intention, green bonds investors often invest in higher CO2 emission firms, but these firms show potential for marginal environmental improvement too. So this paper examined these results rather than the pricing model. So this is a question for you. When you hear green bonds, what comes to your mind first? You can type like a 1 word, 2 words, maximum 3 words. Green bonds. When you hear green bonds, what's the image or the most important wording come to your mind? Green bonds. So you can type multiple words to reflect your understanding of green bonds. So we almost have the story about green bonds related to ESG, green investment, environmental issues, sustainable pollution, renewable energy, and eco-friendly financing, and so on. Okay, so this related to the very focused issues of ESG and the environmental friendly issue. So it's pretty much close to this paper. So this paper, from the literature background, they focus on climate finance. So green bonds is one of the issues, climate finance. And the paper also answered the question about why green bonds matter, and they reference some key papers from Framers 2021 to Holtman 2023, and so on. So you can have a look at the relative literature review for this paper. It's very related. So the paper filled the gap about most of the paper examining green bonds. They focus on the pricing model, but this paper doesn't do that. So they focus on who actually hold green bonds, and this issue was rarely studied by the literature. So this is a very good dimension that we can know much more about the purchasing, the buyer of the green bonds. So because we lack this information about the buyer of the green bonds, and we also don't know the investment type of heterogeneity. So this is another learning from this paper. And also, we have very limited understanding about the consequential list expectation. And this paper answers all of this. So examine key question about how do the green bond investment influence corporate CO2 emission? So the dependent variable is CO2 emission too. There is a climate measures in the model. And also the answer, the first question is the differences between green bonds investor from others in terms of portfolio composition, holding period, and their trading behavior. So, first beginning, you just need to type one word or two words, one word. Green bonds have a higher or lower yield to maturity. Before we get started answering lower, one word, or higher green bonds. Okay. Our answers are very consistent, all lower. So you guys already know the logic behind the green bonds. Because bondholders usually like to purchase higher yield to maturity bonds, right? Higher return, that's better for investor. However, if you intend to purchase green bonds, you are fundamentally different in ethic or your vision or your characteristic. So it deserves to explore more. So green bonds buyer will expect not a higher yield to maturity. Instead, it's pretty low. Why they want to get a lower yield to maturity to reward those issuer? What the reason for that? I purchased this only 2%. If I purchase regular bonds, I can earn 5%. Why I have to? Using the same money, earn the last reward. Why? Any special reason for that? Anyone can answer that? Guru one, any of you? Maybe you will say, I'm just eco-friendly. I have a higher ethical standard. I just love our planet to be very clean. That's a very, intangible motion. But any other motive that you would buy a green bonds with a lower return, you are willing to do that. Why? But it is a higher risk. The result from this paper is higher risk. Volatility is much higher. You have a higher risk and a lower return. It's opposite. Why you pick green bonds? So remember the result. There is only a very small portion of investor that purchase this. Either you are government or you are very individual specialty persons. Okay, so what kind of investor type of this? Just raises one example. Maybe some company, maybe some bank, maybe some institutional investor, and maybe some individuals. Both of them are all possible, right? But why they do this? So there have a lot of questions to be answered. Let's move on to the paper, and we will get back to here. So this paper collect data using Oslo Stock Exchange, Norway's data from these 10 years. So it's a very European-oriented data, and they're using matching methodology to compare green bonds with conventional bonds to isolate the sustainability-related preference. So when you match in both of the group, you have to make sure both groups are equally identical, very similar. So you have to test our matching group in between are similar without significant difference. So all difference will come from the investment type and the control variables. So there have some comparative analysis. So compare green bonds and the traditional regular bonds for insight into motivation and impact. So before we understand the matching methodology, we can see the empirical model here. So the baseline empirical model, dependent variable is not pricing, not Greenian, it's volatility. So this is the portfolio volatility, control for the investor. Green bond, investor type, and other fixed effect and the control variables. So Ayrton. So this is a very basic empirical model. And they also use another advanced empirical model to test the holding period. This is investment behavior, again, to test the regular investor, green bonds investor, and bonds, about green bonds and the regular bonds. Here is the empirical model, investment type, and green bonds, interaction, fixed effect, and control variable. Okay, so using the matching sample, you have to match in regular bonds and green bonds, which means one company simultaneously issue green bonds and the regular bonds. If not simultaneously issue both of them, then you have to match in. How to match? They are the same size, same leverage, very similar characteristic, but they issue green bonds and the other at the same time issue regular bonds. So if any differences in between, that come from the green bonds itself, not from the characteristic of the firm, not come from the other macroeconomic factors. So matching sample have this advantage when you cannot get the sample who issue both green bonds and regular bonds in the same year during the same period. So matching sample get less, right? So 3 green and 50 regular, and there are only 21 green bonds that we cannot match. But other than that, they pick very few matching sample that satisfy the criteria. So only 91 bonds pair. This observation simultaneously issue green bonds and regular bonds. Very small sample. So this is one comment that I think the paper can make it broader to assess the other European countries' data. This is a sample, you can see, increasing significantly. And most of the sector were located in bank, and you can see real estate is a high portion, utility is a high portion, right? And yeah, transportation is relatively high. So most of them focus on pollute sector rather than clean sector, right? So Univeritas also showing the results. So we can see this is the regular bonds. And This fixed rate is a fixed rate or floating rate. And most of the regular bonds, 20% are fixed rate, and the others are floating rate. So first coupon is 3.95. This is for regular bonds. And maturity is 11.2. Compared to green bonds, first coupon is lower, and fixed rate is much higher compared to regular only 24. So green bonds would like to lock the coupon because the coupon is already very low. So they usually would prefer fixed rate rather than floating rate. Maturity is short, much shorter, right? Okay, so this the rating is much lower because a larger number means a lower rating. So green bond usually your issuance may not have a very good rating. Not like TSMC. TSMC is the AA, AAA. But other than TSMC, most of the green bonds issuance, they have a lower rating. It's a 4.75. It's during like 4 triple B to double B during this period, right? And we can see the regular bonds is a 339. So it's during this range. Single A to triple B. So green bond usually have a lower ranking and lower coupon and shorter maturity and prefer fixed rate rather than floating rate. Yeah, that's the observation we get very last sample. And this is the summary statistic of the regular bonds. So you have some data to compare their emission, scope 1, scope 2, scope 3, carbon intensity divided by total assets. Then you have these answers. And GHG direct and indirect. So indirect, including your supply chain emission. Direct is the company from you own. Indirect can combine your supply chain. So there have some evidence. And we can see the overall score is 0.72 for the regular bonds. And their environmental is 0.69. 0.773. This is the regular. Compared to green bonds, we can take a look at that later. So this is the regular bonds. And green bonds, we can see that the coupon is relatively lower. And there's scenario, senior group, senior security. If you have a highest seniority, you may get a higher rate. And fixed rate, positive. For green bond, it's like a downmean. If you green bonds, you will given a 1, or otherwise you might given a 0. So we can see like most likely green bond is fixed rate, and it's a lower coupon, and most of them have a senior option, and usually don't have a credit event, and their default rate usually here is a negative, but it is inconsistent with the story. I have some question about the negative sign, because in column 6, we can see, including all of them, it is insignificant. But the paper is saying that the green bond have a higher default rate. But if a higher default rate, this should be positive. But in column 6 is negative but insignificant. So we can go back to here in column 5. There have some contradiction, maybe. So this is the green bond characteristic about the issuance. Very similar results. So lower coupon is a negative. And if you have a higher ranking or higher investment grade, there are 2 grades. Better than B, then is belong to investment grade, or otherwise belong to jump grade. So if you belong to jump grade, it's another category, or otherwise you belong to investment grade. So investment grade could get a higher positive. Rating the same. And this is the control variables. This is the sectors who purchase, who issuing. So we can continue to see that green bonds, positive environmental score, even though their total overall ESG score is negative, but higher in environmental score. And we have to be very cautious about their governance score is negative. Maybe researcher can do more to examine what's the reason for this negative sign. Because the green bonds have a better environmental score, which is positive but not significant. But their worsening corporate governance score is significant. And their social is negative too. Okay, so issuance about the green bonds have some specialty based on the data. Not all green bonds looks like TSMC, very, very rare. TSMC is a very special case, and the other may not like that. They may be highly polluted, they may like poor governance, or they may not have a very good environmental score because it's positive, but they're not significant because their overall